Have you ever wondered if that property you're eyeing is actually a good investment? In this video, I'm going to show you how to break down any real estate deal with just a few key numbers. By the end, you'll have a clear process to make better decisions for investments. Hey guys, I'm Brandy Lydon, host and founder of Mom You're Not Alone. I'm also a local realtor and investor here in Knoxville, Tennessee. So let's dive in. Number one, we're going to start with the 1% rule. So the 1% rule is a quick, easy way to get a sense of whether a property will generate enough income. Here's how it works. Take the monthly rent the property could generate and divide it by the purchase price. If it's 1% or higher, it's worth a deeper look. For example, if a property costs $200,000, you'd want the monthly rent to be at least $2,000 to meet that 1% rule. If the rent's only $1,500, you might want to pass or renegotiate the rent. So why is this most important? Positive cash flow ensures that your property covers expenses like the mortgage, insurance, and maintenance, leaving you with money in your pocket each month. So you can research rent comps in the area using like a Zillow or Rent-A-Meter to make sure that your rent estimate is accurate. You also could probably get on Craigslist or any local source like that, apartments.com, to figure out what your rent is, a competitive rent rate in your area. Number two, next up, let's talk about ROI. So it's not enough for a property to generate cash flow. It also has to provide a good return on the money that you're putting into it. So calculating your ROI using this formula. So it's going to equal annual cash flow divided by total investment times 100. So here's an example. If your annual cash flow is $6,000 and your total investment, down payment, closing costs, repairs, etc., is $40,000, your return on investment is 15%. So for real estate, you generally want to aim for at least 10% ROI to make it worthwhile. Everyone is going to have their comfort level on this. Don't forget to include all costs in your total investment. This includes your down payment, closing costs, and any rehab or repair expenses. Number three, we want to research the market. Let's zoom out a little. A property might have a great cash flow and ROI, but if the local market is declining, you could be stuck with a long-term problem. So how do you quickly evaluate market potential? First, you want to check population growth and job trends in the area. Is the population increasing? Are businesses moving in or out? These are indicators of a healthy real estate market. So you want to invest in areas where the population and job market are growing, as these factors often drive demand for housing. So to gather this data quickly, you can look at city or state economic reports to see employment trends and upcoming development projects. Websites like the Bureau of Labor Statistics or local government sites often publish this information. You can also use tools like Zillow's neighborhood pages or city data to find reports on new infrastructure projects like schools or public transit, which could increase the property value as well. So you can use tools like City Data or Neighborhood Scout to quickly check demographics, crime rates, school rankings, and new development plans in the area. And these insights can help you spot areas that are primed for growth. So these are going to be great ways to truly determine market. Like I had said before, it could be a good investment, it could be a good ROI, yet the market in that area is going to be declining. So you really want to do your research there. Okay, number four is going to be calculating cap rate. So the cap rate or capitalization rate gives you a quick way to compare multiple deals. So it's calculated by dividing the net operating income by the purchase price. So cap rate equals net operating income divided by purchase price times 100. So for example, if a property generates $10,000 in NOI and costs $200,000, the cap rate's 5%. But here's the key. So understanding the cap rate in context is important. Higher cap rates often indicate higher returns, but they're going to come with more risk. So usually you'll find higher cap rates in riskier markets or neighborhoods that are less stable. And on the other hand, you've got lower cap rates that are around like 4 to 6%. And those are typical for more stable markets where the risk is lower, but the returns are lower as well. So if you're risk adverse, you may prefer a lower cap rate in a prime neighborhood. If you're willing to take more risk for higher returns, you might look for properties with higher cap rates. So in a stable market, a 4 to 6 cap rate is common for residential properties, while an 8 to 10% is typical for commercial properties or riskier investments. So you always want to compare the cap rates with the context of the market you're investing in. Number five, evaluate the long-term potential. So finally, always having an exit strategy in mind. What is your plan for this property in 5 years, 10 years, 20 years? Are you planning to hold it for cash flow? Are you planning to sell it for appreciation or eventually refinance the property? So understanding your long-term goals will help you make a better decision up front. You also want to look into local development plans to see if new schools, new businesses, or infrastructure are being built. These developments can boost property values over time and enhance your long-term returns. So if you know the area is being revitalized or large companies are moving in, that could signal future appreciation. So look into local development plans to see if new schools, new businesses, or infrastructure are being built. These can boost your property's value over time. All right, there you have it. You can analyze any real estate deal by focusing on cash flow, ROI, market potential, cap rates, and long-term strategy. Don't forget, always do your research and trust the numbers. If you found this video helpful, make sure to like and subscribe today for more tips on real estate investing. Thank you.